get the hell out of credit. So the man in the street then says, how do I get out of credit? I say, well, the answer is you got to get into real money, which is and has been ever since Roman times, gold. That's real money. And don't think that the gold price is rising. It's not. It's your currency falling. Well, commodities have started to rise. And it's really where the flows of credit go. That's the key to it. So, I mean, the credit has been going into, financial instruments. It's been going into equities. It's been going into government bonds, all that sort of stuff, and not into commodities. So, but that is now changing. And I think this last year we saw commodities rise roughly 18% or a figure like that, somewhere between 15 and 20%. Gold, of course, rose by more than that, about 24, 25%. So, yeah, we're seeing things turn round, and a lot of that is not so much demand for commodities, but the declining purchasing power of currencies, which are credit. I mean, the top level of credit is a currency. So I would expect to see commodity values measured in these currencies increasing over next year.
Yeah.
Yeah, I think the first thing to understand, and this is a point that actually the central banks understand, is that it's not going up. It's not gold going up. Its currency is going down. So that's the first thing and it's a very, very important distinction. The Bank of China, for example, you think it's buying gold. No, the emphasis is that it's selling dollars and it's selling euros. And other central banks are doing the same thing. I mean, they're not necessarily saying that the whole thing is going to fall apart. What they're saying is that there is now a greater risk in paper currencies, so we need to adjust our reserves accordingly. And so that's what they've been doing. There is also a geopolitical element in it because they can see that Russia and China have accumulated large quantities of gold. If you're a member of the Shanghai Cooperation Organization or an affiliate or an associate, dialogue partner, I think is the term as well, then, in various meetings, you will have discussed gold with, your opposite numbers. And I know pretty well, what the discussion is likely to be. It's likely to be, that the West, the dollar is toast over time. Anyway, we need to move away from the dollar because we don't want the American interference. So, that actually could be rather nasty for the dollar. So we need to have gold to protect our own currencies. So, the whole thing is there. And also, if you go back to the St. Petersburg International Financial Conference back in 22, this was after the West had stolen Russian reserves to the tune of over $300 million. Putin said quite clear, this is what these guys do to you. So don't have your eggs in the Western basket. Be as independent as you can. And furthermore, if you've got any gold stored in, with Western central banks in the Western Alliance, you would be wise to get it out. So you can see that there is a far greater understanding of the role of gold in this current situation than there is, let us say, in Western financial markets. They're beginning to learn. And I mean, I'm looking at gold as we're talking. I mean, today's what, the 22nd of January?
Yeah. Yeah.
Gold price is 2757. That's literally within what, 30 odd dollars of the all-time high, which was back in last early November. So, it looks like it's got enough momentum to go higher. But I mean, actually, what's happening is that it's going lower. The dollar's going lower. Now, the reason the dollar's going lower is we've got a new president who's a spendthrift, and he's going to introduce tariffs against China and against the European Union in particular. And the effect of that is that the consumer is going to have to pay higher prices. The consumer price index rises. What can the Fed do? Not a lot. It can't cut interest rates. And then you've got the budget deficit, which I think will be somewhere, it could be 2.5 trillion. And that's just inflation. That's debasement of the currency being injected into GDP. So yeah, and non-Americans, foreigners holding dollars are watching this, and this is the assessment they're making. They can see that interest rates are going to have to rise. They can see that the US economy, while it appears on the surface to be growing, in fact, it's not productive. If anything, it's an inflationary form of growth. Uh, and and the US is in a debt trap. And Trump, I mean, he's not very much liked in Europe, except by, if you like, the people who are sort of anti-socialist, who are gathering, incidentally. I'm not saying that what he's doing is all bad by any means, but on economics, I'm afraid that he's going to drive up the rate of inflation, which, put another way, is the purchasing power of the dollar going down. And who's going to want to buy the dollar? Who's going to want to fund government debt? I mean, at this rate, what, 5%? Well, it's 4.75% or something on the 10-year US Treasury. No, I don't think so. 5%? No, maybe not. You could be looking at what, 6, 7%? And when it gets there, what happens to the arithmetic about the US government debt? Oh my God, it's getting worse and worse and worse. No, we will just get out, don't get involved. And if anything, if we got dollars, get out and go and buy some real money with it, which is
Yeah,
gold.
yeah,
Yeah.
yeah, agreed. What about silver? What will be the trigger for higher silver prices?
Well, I think it's more the commodity story that you brought up just a moment ago. I mean, it's interesting. Silver in the past has always been roughly twice as volatile as gold.
Yeah,
So we hang on to that sort of idea as silver bulls that gold if gold breaks through this 2,800 level, let's say, then I think silver will be shooting off, because I think there comes a point where people look at it and they say, gold's gone up. It's now going into new high ground. Silver's been left behind. We got to buy silver. Yeah. So I think at that stage it rockets. It could be starting to rocket now. I mean, basically, it's kept pace with gold last year. I mean, they were both up about 25, 26% or something like that. If I look at the gold silver ratio at the moment, it's just under 90. I mean, that's crazy, absolutely crazy. On the industrial side, I mean, it's not priced as money. This is what that ratio is telling us. If it was priced as money, it would be under 20. Not priced as money. It's essentially an industrial commodity with, if you like, money sentiment in it. But it's been in deficit, according to the Silver Institute, for the last 4 years. So this is a commodity which, the whole commodity sort of whole commodity complex begins to move higher on the back of gold. I think silver will be leading the charge.
it's a
I
physical.
mean, there's money, no. I mean, my message is get the hell out of credit. So the man in the street then says, how do I get out of credit?
Yeah, exactly.
And I say, well, the answer is you got to get into real money, which is and has been ever since Roman times gold. That's real money. And don't think that the gold price is rising. It's not. It's your currency falling. So get out of credit. Your currency is the highest form of credit in your nation. Get out of credit. Get into real money. That's the thing to do.
Yeah, that's smart advice. Quick return to silver. Do you really believe that silver price is manipulated? And if yes, will we see an end to that thesis?
Well, um, I think the silver price has for a long time been controlled. And my suspicion is that it's been controlled by China, because for China it's a staple commodity, really, and even more so given the global move towards photovoltaic cells. And of course, India is now getting into the photovoltaic cell manufacturing industry as well. So they're becoming a demand source. And I think that control over the price is actually beginning to be lost by China because of India coming into it. Um, I discovered that this was the way it worked a long time ago because I was speaking at a conference in New York, I think back in about 2010, something like that. And it was attended by a lot of silver mines. And these silver miners are obviously, basically trying to promote their share prices, looking for capital, whatever, whatever. And I asked all of them one question, and that is, when you've produced your silver, your silver doré, um, can you walk me through what happens? And they said, well, the first thing is the man from Glencore comes along, and he evaluates, he gives a value to the to the doré. The doré is then shipped off for refining. We don't know where it goes. It doesn't interest us. The point is that we're paid by the bank introduced by Glencore. And the bank would probably be JP Morgan.
Yeah.
Yeah. JP Morgan basically was financing the mines with the collateral being the silver going to the refiner in China because refining silver is a dirty job. You know, no, none of us environmental people want to do this, so China does it. China keeps the silver or whatever, whatever, whatever. And they repay JP Morgan. But in terms of managing the price, JP Morgan, I think, is in league with China in the management of the price on the futures exchange and also in London. So you can see it's a triangle.
Yeah.
It's a triangle. As far as the mine is concerned, they need upfront payment because they have got costs. They've got to pay their workers and the diesel for all the equipment and all this sort of stuff. So there's that that they get up front, and JP Morgan basically gets the business. Glencore also gets obviously fees out of this, and China does the refining. And guess who's got control over the silver? China. Yep.
Yeah.
So that's it, and it's the function of JP Morgan, if you like, to help manage the price, because the last thing China wants is to see the price rise. So they will feed in, whatever is necessary to keep the price down. I suspect that the Silver Institute's numbers are a bit suspect. I mean, it's very difficult for them to get accurate statistics, let's face it. But I don't think that changes the underlying situation that there has been, if you like, a lack of production and a lack of scrap compared with increasing demand. And that's certainly been the case for several years. If gold is rising, given that over a long period of time, gold is stable, I mean, the purchasing power of gold measured in commodities can double or halve. But that's a lot less volatile than what we see with currencies. I mean, for example, a barrel of oil in 1950 was something like $2.53 or 56 or something. And that was when there were $35 to an ounce of gold. Since then, particularly after 1974, when the dollar's purchasing power started declining, the price of oil has been incredibly volatile and gone far higher. And that same barrel today, having been up to 140 at one stage, $140, is now roughly $77. So you can see that the volatility is actually all in the currency.
Yeah.
I reckon the value of oil measured in gold is roughly the value of oil measured in gold, I think, is around about 60% of what it was back in 1950. So if you like, you can say that gold has gone up relative to oil, or oil has gone down relative to, that's so, the relative volatility is very, very small. It really is. So I think that I think that the future outlook for commodities is going to be very much dependent on the loss of purchasing power of currencies. And of course, this is no analyst in the industry looks at it this way, because they all account in dollars or euros or whatever it is. So what they're looking at this. They're looking at commodity supply and demand in the context of, we're accounting in dollars. So if they make a dollar price forecast, they see, well, you got this supply, this demand is likely to drive prices up, but they never ever think that the variation in price is mainly coming from the currency side. And this is the point they rarely miss.